Hey everyone, welcome back to Corporate Decoder, the place where we unravel the wild world of corporate finance, and oh boy do we have a juicy one for you today. Chemung Financial Corporation, where we will be diving deep into their latest quarterly report, the kind of report that usually puts you to sleep, but we promise to make it interesting. So imagine a company doing okay financially, but also making some really interesting strategic moves like selling off a big chunk of its investments and taking on new debt to shake things up. And that is just the tip of the iceberg. Let's start by looking at the big picture with their balance sheet. The company ended September 2025 with total assets of about $2.7 billion, which is a little less than the end of 2024. That is a drop of almost 3% now. Where did that money go? Well, their investment securities took a massive hit, dropping by over $250 million. That is a nearly 47% decrease. This is a huge move, folks, it signed. It's a big strategic shift. They are essentially shrinking their investment portfolio quite a bit, but hey, they did increase their loans by a healthy 6.3%, totaling over $2.2 billion. This is likely their core business growing, and guess what? Their allowance for credit losses also went up by over 10%. This means they are setting aside more money just in case some of those loans don't get paid back a good cautious move in uncertain times, and this is even with their non-performing loans actually decreasing. Now let's talk about how they made money, or in some cases lost money. Their net income for the third quarter of 2025 was about $7.8 million, a nice jump from just over $5.7 million in the same quarter last year. That is a solid 36% increase. That is the kind of news investors love to see their earnings. Per share also climbed nicely from $1.19 to $1.62. It looks like their core banking operations are doing well, driving this profit increase. But then we look at the 9-month results and it is a completely different story. For the first 9 months of 2025, net income plunged to $7.4 million from a much higher $17.8 million in the same period last year. That is a massive 58.5% drop their earnings. Per share followed suit, dropping from $3.72 to $1.53. This big drop is largely due to a massive hit in their non-interest income, which fell by almost 93% year over year. Why the huge drop? Well, they sold a bunch of investments and took a $17.5 million loss on it. That is a big deal for a company of this size. Looking at shareholders' equity, it is up significantly from the end of last year. This is mostly because their accumulated other comprehensive income, which is basically an accounting measure for unrealized gains and losses on investments, improved quite a bit. This is partly due to the sale of those securities we just talked about, and also seems like the market for their remaining investments is doing better. Their book value per share also jumped nicely to over $50, which is great news for shareholders. In terms of cash flow, their operating activities provided over $29 million in the first 9 months of 2025, which is more than the previous year. That is a good sign, meaning their core business is generating enough cash. But their investing activities provided a huge influx of cash, nearly $140 million. This is mainly from selling those securities we mentioned earlier. It is like they cashed out of a big investment then. On the financing side, cash outflow really jumped up by over $108 million. This was mainly due to paying down a lot of their debt and reducing their time deposits, so they are actively reshaping their financial structure. It is a lot of shuffling around of money. Let's check out their loans by division for Chemung Canal Trust Company. Their loans have actually gone down slightly year over year, but in their Capital Bank division, loans are up significantly, an increase of over $1.3 billion. That is a substantial jump. And then their Canal Bank division loans have nearly doubled compared to the end of last year. That is explosive growth in that area. It seems like they are really pushing lending in these specific markets, and it is paying off. When we look at how their commercial real estate loans are spread out, we see a heavy concentration in multifamily properties. That is 33.8% of their commercial real estate loans. That is a lot of eggs in one basket. And then we have retail at 18.2% and office at 9.7%. Construction and land development is also a part of it. At 8%, these types of loans can be very sensitive to economic downturns, especially with rising interest rates and the shift toward remote work, which might impact office and retail spaces in the future. Now, for the part everyone cares about, non-performing assets, the loans that are in trouble. Their non-performing loans are actually down compared to the end of last year, sitting at about $7.8 million, which is less than 0.5% of their total loans. That is pretty good. Their allowance for credit losses, which is the money set aside for bad loans, is actually higher than their non-performing loans. This is a good sign. It means they are well prepared for potential loan defaults. Let's look at their deposits total. Deposits are down slightly, but check this out. Their brokered deposits, which are like hot potato money, they don't want to hold on to, are completely gone. That is a huge shift. This means they are relying more on their own customers for funding, which is generally a more stable source, and their customer deposits, particularly money market and interest, bearing demand deposits have grown nicely, this suggests their core customers are sticking with them. Now, for the regulators and capital requirements, the bank's capital ratios are really solid. They are way above the minimum needed to be considered well capitalized, which is great news for stability, especially with all the financial shuffling they've been doing this. It means they are in a strong financial position to weather any storms and continue growing their business, looking at the whole picture Chemung Financie. ALV. Corporation is in an interesting phase. They are aggressively repositioning their balance sheet by selling investments and taking on new debt. This has led to a big hit in their quarterly earnings due to that sale, but their core banking operation seems strong, especially in commercial lending growth in certain divisions is really picking up speed. And their deposit base is getting more stable. They've also got a very healthy capital cushion, making them look financially sound for the future. The big question is whether this strategic shift will pay off in the long run, and if they can manage the risks associated with their heavy commercial real estate exposure, especially in this economic climate. Alright, that is our deep dive into Chemung Financial Corporation's latest report. What do you think of their big bet on the market and their loan growth strategy? Let us know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate insights. Don't forget to join our Discord community linked in the description for more discussions like this. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.